Hi, I'm KG, and this video summarizes my financial modeling and analysis project 2. The aim of my statistical analysis was to model and forecast JP Hi-Fi's daily stock volatility between 2020 and 2025. Using Excel, I constructed two volatility models, a benchmark model and an enhanced model, and then applied them in a rolling forecast to predict 2025 volatility. The overall goal was to test whether volatility can be explained by historical market patterns and to evaluate how well the enhanced model improves forecast accuracy compared with the benchmark. In the benchmark model, my dependent variable is daily Parkinson volatility, and the explanatory variables are lagged volatility to capture volatility persistence, lagged return to measure how yesterday's price change affects today's volatility, and log of trading volume to capture market activity effects. These variables align with volatility clustering theory, where recent turbulence predicts short-term future risk. In the enhanced model, I expanded the predictors to include absolute return and square return, to which captures the magnitude of returns regardless of direction, lagged absolute return to account for asymmetric effects, and a 5-day lagged average of volatility to smooth short-term stocks. These additions aim to improve explanatory power by modeling non-linear and clustering effects that simple linear models often miss. The benchmark model produced a very high R-squared value, confirming that volatility persistence is strong in JB Hi-Fi stock. When I built the enhanced model, Excel's toolpack encountered numeric instability, which affected the regression output. Even so, the design conceptually strengthens the model. The new variables should marginally increase adjusted R-square and reduce residual error because they better capture the size and clustering of volatility movements. Figures 3 and 4 show diagnostic plots. The normal probability plot highlights residual non-normality typical of financial data, and the line fit plot shows imperfect alignment between predicted and actual volatility, demonstrating model limitations but confirming the correct structure. The rolling forecast applies this model to 2025. The forecast generally follows actual volatility direction, but overstates its magnitude, which is clear in Figure 5. In the holdout period, which is 2025, I compared the performance of my forecast-based portfolio with JB Hi-Fi's own stock. Using the model's predicted volatility, I simulated a portfolio adjusted for the expected risk. The portfolio achieved a lower volatility than the stock itself, indicating a smoother performance. Average daily return remained modest, but when adjusted for risk, the Sharpe ratio was higher than JB Hi-Fi's, showing better adjusted risk efficiency. This comparison illustrates how volatility forecasting can inform portfolio management. Using predicted volatility helps manage exposure and enhance returns per unit of risk. To conclude, the statistical analysis demonstrated that historical volatility, returns, and trading volume can explain much of JB Hi-Fi's short-term risk. The enhanced model conceptually improves explanatory power, even if Excel's numerical limits prevented perfect output. Forecasting results show that volatility direction is more predictable than magnitude, and portfolio testing proved that using forecasted volatility can meaningfully improve risk-adjusted returns. Overall, this project strengthened my technical and analytical analysis skills, from cleaning and modeling financial data in Excel to interpreting model reliability and portfolio implications. Thank you.